Welcome to the Deep Dive. Today we're jumping into a world that often feels, well, pretty mysterious, maybe even a bit scary. Financial derivatives. You hear terms like risk management, and maybe your eyes glaze over, but trust me, our look at Satyajit Das's Traders, Guns, and Money is going to uncover some pretty wild stuff.
It really is. Das was deep in the industry for, over 25 years? And this book, it's just raw. An unfiltered look at what really goes on.
Yeah, and it's definitely not some dry finance textbook. I mean, look at the reviews. Filled with dirty little secrets. Anyone who has worked on a trading floor will nod and laugh, but, and I quote, those who have not will shake their heads and cry.
Huh, that sounds about right.
It apparently strips bare the workings of a complex betting game. And get this, one review said it was more riveting than, yes, the Da Vinci Code.
Wow, okay, high praise. So yeah, buckle up.
Definitely.
What grabs you right away is this analogy Das uses to explain the whole derivatives world. He calls it the knowns and unknowns.
Right, the shoes thing.
Exactly. Men's shoes, he says, are a known known.
Yeah.
You know what you need, you know what you're getting. Pretty straightforward. But women's shoes, like, Manolo Blahniks or Jimmy Choo's, those are closer to derivatives. Much more complex, maybe less predictable.
Okay, so break down those four categories for us.
Right. So first, the known known, his blunt take. Derivatives are WMDs, weapons of mass destruction.
Doesn't mince words, does it?
Yeah, not at all. Then, the unknown known. This is where you don't even realize you need the product in the first place.
Okay. Intriguing.
Then the known unknown. You've heard of the product, maybe, but you have absolutely no idea what it actually does, like that example he gives.
Oh, the double knockout currency option with rebate?
That's the one. Sounds like gibberish.
Totally.
And the last one.
That's the kicker. The unknown unknown. You don't know what it does, and you have no clue what you should even pay for it.
Oof. That sounds dangerous.
It really captures the opacity, the confusion around these things. And that framework is going to guide us as we go through this. Okay, so our mission today is to unpack this chapter by chapter, get into the hard facts, but also the, let's say, soft underbelly of derivatives using Das's book. Sort of a shortcut to understanding this whole crazy game.
Exactly. Let's start where he starts, the prologue.
Right. The Indonesian needlemaker story.
Yeah, OCM. And these guys, Aduiko and Budititra, the scene that just sets the whole bizarre tone is this meeting where their lawyer, Morrison, spends like 5 minutes meticulously sharpening pencils.
Oh yeah, the $2,000 pencil sharpening.
Precisely. It's this absurd Zen moment before a super high-stakes meeting. Just highlights the surreal world they operate in.
And leads right into how OCM got sucked into these complex financial transactions. They were just looking for easy money. Started with something called an arrears swap.
Which sounds technical, but basically it's a way to swap interest rate payments where the calculation is based on past rates. Can lead to some nasty surprises.
And it escalated fast, didn't it? To that double-up swap.
Oh, massively. The bet was huge.
Yeah.
If dollar interest rates went down, the whole deal size would double. From $300 million to $600 million.
Wow.
And guess what? Rates went down. OCM was suddenly facing losses bigger than their entire company's value. Just unpayable.
So the dealer, the bank, they must have been panicking.
Totally. Their internal emails, Das reveals, were flying. Credit department saying the risk was totally unacceptable, pushing to kill the deal. Their lawyers, kill him and bill him, as he calls them.
It's subtle.
Right. They are ready to go for the coup de grace, a summary judgment to just crush OCM.
But then there's that twist with Morrison, the lawyer.
Yeah, the meeting. Everyone expects OCM to just roll over, but Morrison comes in, acts all bold, and just casually drops names of other big companies that got burned by derivatives. Procter & Gamble, Gibson greeting cards.
Orange County.
Orange County, exactly. And suddenly, poof. The summary judgment gets withdrawn.
It's amazing. It just shows that core dynamic, right? Fear and greed rule financial markets.
Absolutely. And that Keynesian idea, he mentions people buy stuff just because they think someone else will buy it for more later, ignoring the actual value. It creates these bubbles that eventually just go kaput. It really highlights the danger when perceived sophistication meets massive leverage.
Okay, that prologue definitely sets a dramatic stage. Let's move into chapter 1. Financial WMDs derivatives demagoguery. This gets right into that big 2003 debate. Buffett calling them WMDs.
Right, versus Alan Greenspan, who was, let's say, more sanguine about them.
So how do we even get here?
Right.
Das traces it back, right?
Yeah, back to the 70s. The Chicago School, Fama, Miller, and then especially Black-Scholes-Merton, they developed the Black-Scholes option pricing model.
Which is a huge deal.
Huge. Made pricing seem more scientific. But Das points out that he and many others really learned this stuff the hard way through mistakes on the job. Firms would offer training, sure, but only...
Just far enough.
Exactly. Enough to get you trading, but maybe not enough to fully understand the risks you were taking or selling. It was a bit selective.
And then came swaps and the OTC market over the counter.
Right, where deals are private, not on a public exchange. That, Das says, changed the dynamics of derivatives forever. It just exploded into this gigantic system of betting on changes in prices.
And this is where the public story and the private reality diverge. The secret subtexts.
Precisely. Publicly, it was all about hedging. You know, farmers protecting against crop price drops, sensible stuff. But because these things settled in cash, anyone could play. You didn't need to own the underlying thing. And that meant massive leverage. If you buy options, leverage can be good. But if you sell them...
That's the eating like chickens and shitting like elephants part.
Ha! Yes. Tiny potential gains, catastrophic potential losses.
And this faith in the models, the pricing models, just got baked in, even when they didn't really match reality.
Yeah, the hubris in the models became entrenched, even though, as Das notes, they often proved poor approximations of the ferocity of markets in meltdown. And this set the scene for the serial crimes of the 90s. Big names getting hit hard, P&G, Orange County again, leading up to the CDO market collapse in 2001.
And that inverse floater thing sounds like a classic example.
Textbook case. Sold as a way to get high returns if interest rates fell. But hidden inside was this huge bet on future interest rates that, frankly, most investors probably didn't grasp.
And the dealers.
For them, the book's pretty clear. Ethical debates were largely irrelevant. It was all about the profit.
Okay, Chapter 2. Beautiful lies the sell side. He paints quite a picture of the trading rooms.
Oh, yeah. Huge, like, football fields, constant noise screens. He calls them the last feudal kingdoms.
Feudal kingdoms?
Yeah, with these omnipotent divine warlords, the bosses, and their Ronin lieutenants. And fascinatingly, he says the internal rivalries were often worse than competing with other banks. Loyalty was all about your share of plunder.
Sounds intense. And the salespeople, the sell side, how do they fit in?
Well, initially it was just about being liked and trusted, you know, smile and dial, build relationships.
Right.
But it evolved. They started needing to provide trade ideas, often pushing complex stuff onto clients who, as Das puts it, had basically outsourced their brains.
Ouch. And that led to the research mirage.
Yeah, this desperate scramble to seem different, leading to floods of irrelevant and superfluous research that mostly just clogged up fax machines or went straight in the bin.
So what about the actual traders? What were they doing?
Their job was often unbundling these complex derivatives into simpler parts. You had flow traders making markets for clients, but then you had prop traders, proprietary trading.
That's the bank betting its own money.
Exactly.
Yeah.
Pure speculation, trying to make money from price moves, sometimes even trading against their own clients and predicting those moves. Das mocks technical analysis, citing that experiment where analysts confidently charted random numbers, calls it a hoax.
And the analysts writing the research, their incentives were skewed too.
Hugely. Pay was often tied to how much business they brought in. That led to things like spinning IPOs, hyping them up, and generally fueling unsustainable inflation in value, which of course blew up with the dot-com bust in 2001.
He also talks about the culture, right? The Tower of Babel.
Yeah, lots of tribalism, cultural clashes. He gives that funny example of an American trader hearing a UK company was on their uppers and thinking it was good news.
Huh. Doesn't mean doing well, does it?
Not quite. And management wasn't much better, just a succession of fads pushed by snake oil salespeople, management consultants, using baffling jargon to create often unworkable business models.
Yeah, and the core attitude.
Summed up by that acronym, IBG, YBG. I be gone, you be gone. Make your money, get your bonus, and get out before the trades blow up.
Grim. Okay, Chapter 3. True lies the buy side. The other side of the coin.
He calls it a world of true lies. Kicks off with a story about a big hedge fund arguing over trade values, and this sales head, Nero, just brutally tells them, post the dough or we cut your positions. Boom. Fund collapses.
Sets the tone again, and he talks about the paradox of hedging.
Yeah, it's kind of mind-bending. Hedging is supposed to remove the need to predict the future, right?
No.
But often, figuring out the right hedge seemed to require knowing exactly what prices were going to do anyway. And even simple strategies like buying forward to lock in a price have a cost. No free lunch.
He gives some big examples of hedging gone wrong.
Hedging.
Two deaths.
Two huge ones. First, Walt Disney back in the 80s. They had yen royalties coming in, and they were terrified the yen would fall. So they hedged.
Yeah.
Then came the Plaza Accord, and the yen didn't fall. It soared, like 310% appreciation. Massive currency losses for Disney, just like our noodle maker friend.
Wow. And the other one, Metallgesellschaft.
MG, yeah. German company. They used this complex stack hedge strategy involving rolling over short-term futures contracts. Huge position.
Didn't work out.
Disaster. Market dynamics called contango, where future prices are higher than spot prices made rolling the hedges incredibly expensive, nearly bankrupted the company. Shows how even trying to be prudent can backfire spectacularly.
Then there's Zaiteku in Japan.
Right, financial engineering. Basically, corporate treasuries stopped just managing company cash and became active trading desks, trying to make profits from financial markets, often to cover up weak performance in their actual businesses. The corporation as casino, as Das puts it.
And the P&G versus Bankers Trust case is classic.
Oh, yeah. P&G lost, $157 million on some super complex derivative. They claimed they were just farm boys relying on the experts at Bankers Trust.
And Bankers Trust.
Got caught on tape basically admitting they were trying to mislead P&G about how bad the losses were. Really damaging stuff.
Who exactly is the buy side?
It's varied. Insurance companies, pension funds, those gnomes of Zermatt, Swiss banks, even Belgian dentist, apparently a code for tax refugees.
And fund managers. How do they come out of this?
Not great, often. Lots of jargon like alpha and beta, trying to sound smart. But Des points out most actively managed funds actually underperform the market average. It's hard to consistently beat the market, especially as you get bigger. The winner's curse.
Hence the rise of index funds. What about hedge funds?
Ah, the aggressive players. Often started by traders who left the big banks. They use derivatives heavily for short selling, for massive leverage. They're seen as essential players now.
And the most famous blow-up there has to be LTCM.
Long-term capital management, yeah. Founded by literal Nobel Prize winners. They made these enormous bets that certain prices would converge, leveraged up to the eyeballs.
But they didn't converge fast enough.
Exactly. Markets went haywire, volatility spiked way beyond what their models predicted, correlations broke down, and they just ran out of money. Needed a massive bailout organized by the Fed.
And that story about the asset consultant.
Oh, that's brilliant. Consultant boasts about outperforming the benchmark by 3%. Sounds good, right?
Yeah.
Then reveals the portfolio was actually down 45%. It's just that the benchmark fell 48%. It perfectly skewers the whole game of relative returns.
Okay, chapter 4. Show me the money greed lost and regained. Love the Galbraith quote he opens with.
Nothing so gives the illusion of intelligence as personal association with large sums of money. It is also, alas, an illusion. Perfect.
So finance doesn't really make money?
Not in the way factories make goods. Das argues it mostly just transfers wealth. And how do you profit? By gouging clients, you can gouge other firms. You can gouge others within your firm.
Charming.
Isn't it? And reported profits. There's an uncertainty principle there. What gets reported might not be what bonuses are based on.
And pricing these complex things.
It's often like trading objets are. It helps if the buyer has no idea of what they're buying or it's worth. Back to the noodle maker again. Dealers use brand awareness, flattery, and bribery. They actively fight transparency.
Like in Mumbai, resisting electronic trading.
Exactly, because electronic trading means clearer prices, which means lower profits for the dealers. They want to keep things opaque.
And this is where prop trading really took off.
Yeah, banks shifted focus from just serving clients, agency business, to making their own bets, proprietary trading, trying to predict prices using quantitative analysis, which Days compares to reading the entrails of a slaughtered ox. Remember the technical analysis hoax?
Right, and they even convinced accountants to use mark-to-market accounting.
Yep. Sold it as a way to show profits sooner upfronting of income. But for stuff that doesn't trade often, it became mark to myth or mark to fair value, basically guessing. This subjectivity opened the door to hiding losses or inflating gains.
Which leads to some famous blow-ups.
Oh yeah. Kidderby Body, Baring Brothers, Nick Leeson, and the secret 8888 account, nearly $900 million gone. All First Bank, $690 million lost by John Rusnak using fake docs. It happens again and again.
And the bonus culture fuels this.
Absolutely. Bonuses often tied directly to reported profits, maybe 10% of net revenues. Huge natural incentive to overstate earnings. And if things went wrong, traders often just jump ship to another firm before the losses surface.
Which brings us to the ultimate safety net.
Too big to fail. The ultimate moral hazard. Traders play with other people's money. If they win, they get huge bonuses. If they lose so badly, the bank might collapse.
The government steps in.
Right. Privatization of gains, the socialization of losses.
Okay, Chapter 5. The perfect storm, risk mismanagement by the numbers. Risk management sounds sensible, but...
But Das says it's often just a fancy term for taking risk, focusing only on unexpected losses. In the early days, he calls bank risk management PUNTCO, the Asset Liability Committee, basically just placing bets on interest rates.
And they wanted self-regulation.
Lobbied hard for it. But Das is cynical. Risk management is like any religious text. Nobody's willing to criticize it in public, but few follow it completely in private.
So it's mostly spin.
A lot of it seems to be. Military jargon like DEFCON scales, fancy terms like risk regimes, colonization of uncertainty, but underneath it's often just risk quantification, producing numbers.
Numbers that give false comfort.
Exactly. Calculated to multiple decimal points, suggesting precision even when the inputs are just educated guesses. Like that myth about JP Morgan's 4.15 report one magic number summarizing all the bank's risk. Reality, much messier.
And the main tool was VAR, value at risk.
Yeah, VAR. Supposed to tell you the maximum you're likely to lose on a given day with, say, 99% confidence. The problem was when markets were calm, volatility was low, so VAR numbers were low.
Which made banks feel safe.
Worse, it encouraged them to double their positions to hit profit targets. Experienced traders, though, they fenced the calm before the storm, and they knew about fat tails.
Fat tails.
Those rare extreme events that the models based on normal distributions don't predict well. The stuff that really blows you up. And because everyone used similar models, they all acted the same way, lemming-like fashion, which ironically made the whole system riskier.
LTCM again.
Classic case study in model failure. Underestimated volatility, assumed they could sell assets quickly in a crisis.
Nope.
So despite all the talk, big losses keep happening.
Regularly. Suggests the systems are either flawed or just ignored when profits are rolling in.
Chapter 6. Supermodels, derivative algorithms. The quants enter the picture.
Right, the rocket scientists,
Yeah.
physicists, engineers, mathematicians migrating from defense or academia to Wall Street. The best and brightest went from making war to making money, as Das puts it.
And they found finance easy.
Well, many were surprised. Used to come place physics, they found a lot of financial models was, in Das's words, trivial undergraduate stuff. But the money, way more than academia, the prisoner of Wall Street dilemma.
But they didn't always mesh with the traders.
Oh, definite culture wars. The analytical, quiet quants versus the loud, intuitive traders. Springsteen and Shostakovich, he calls it. He tells a funny story about a quant misinterpreting a trader talking about the opera Madame Butterfly.
Huh. And the models themselves, are they really that complex? For many basic products, no. It's mostly compound interest and present value mathematics. But options were different. Before Black, Scholes, and Merton, pricing was kind of arbitrary.
Their model changed everything.
Revolutionized it. Assumed prices move randomly, assumed you knew the volatility, and boiled it down to volatility being the key unknown input you had to estimate.
And then came the Greeks.
Delta, gamma, vega, theta, rho. Yeah. These are measures of how sensitive an option's price is to different factors. Price changes, time decay, volatility changes. Traders use them to hedge their positions.
But the Amameras, the models can be wrong.
Critically, if the model's assumptions don't hold, the prices and hedges are also wrong. Dash shares a terrifying personal story of a currency option trade where the market just jumped violently, bypassing all the levels his model predicted.
How did he survive?
Not the model. It was the chief currency trader, Marty, who used gut instinct, market feel, shock, and awe tactics to manage the chaos. Real world versus theory.
Recurring theme.
And it ends perfectly with Isaac Newton, who lost a fortune in the South Sea bubble, lamenting, "I can calculate the motion of heavenly bodies, but not the madness of people." Models can't capture human psychology.
So true. Chapter 7. Games without frontiers. The inverse world of structured products. He starts with a memorable quote.
Leo Melamed saying swaps were something between husband and wife in New Jersey. And Dace adds, if swaps are sex, then structured products are kinky sex.
So these were driven by the search for higher profits.
Exactly. Intense competition meant dealers had to innovate. They started bundling complex derivatives together into structured products, often sold using the line, your competitor is doing these structures. Peer pressure.
And they moved beyond just interest rates and currencies.
Oh, yeah. into new areas, like catastrophe bonds linked to earthquakes or hurricanes, supposedly zero beta uncorrelated with traditional markets.
Orange County comes up again here, doesn't it?
Big time. Their treasurer, Robert Citron, got hooked on yield enhancement promises. Invested massively in inverse floaters. Das calls them straight, leveraged, turbocharged, toxic.
How leveraged?
Hugely. A $20 billion portfolio built on only $7 billion of investment. Super sensitive to rising interest rates. When rates went up, boom, over $1.5 billion in losses. Cue the blame game.
And people found ways around regulations.
Especially in Japan, if derivatives were restricted, dealers would create securities that looked and acted exactly like derivatives, but technically weren't. A fertile market in creating structures that got around the regulations.
Fueled by things like the belief in a weak yen.
Yeah, Japanese investors had this unshakable belief the yen would stay weak, got burned after the Plaza Accord. This led to demand for things like dual currency bonds, paying interest in one currency, principal in another, driven by specific tax rules or accounting quirks.
And the PRDC bonds, perpetual reverse dual currency.
Oh, those were nasty. Sold to ordinary Japanese retail investors. Promised high coupons paid in US dollars, but the actual payout was in yen. As the yen strengthened over decades, the interest rate effectively went to zero for maybe 30 years. Deals left deep underwater.
How do they even create some of these?
Often using repackaging vehicles, SPVs, special purpose vehicles. Basically, shell companies set up, often offshore and unregulated, to buy normal bonds and then slice and dice them or reverse engineer them into these complex structured products.
And if things went wrong, litigation.
Often take no prisoners stuff. Das recounts a case where his side, despite weak legal ground, basically threatened to destroy the dealer's reputation, their brand equity, to force a settlement. Mutually assured destruction.
And mis-selling was common.
Rampant, especially to less sophisticated investors. He mentions a Singapore salesperson targeting a woman saving for her son's education, and the Citibank Japan scandal selling complex products without proper risk disclosure.
Moving to equity derivatives in Chapter 8, share and share alike derivative inequity. The focus shifts here.
Yeah, often towards tax. He says with equity derivatives, a few tweaks of the assumed dividends and how they are to be taxed will produce just about any number that you want.
Like the UK dividend tax loophole.
Classic example. Foreign investors faced a withholding tax. Dealers used options to create a sleight of hand where investors got the economic benefit of owning shares, including the tax credit, without actually owning them directly. Dealers took a cut by playing different tax rates.
Big money involved.
Huge. London banks apparently lost around $1 billion when the rules changed suddenly.
Wow. And derivatives as loan replacements.
Yeah, a way for banks to effectively lend money against shares, maybe to companies or execs who couldn't get normal loans. But if the shares tanked, the bank's recovery position was often worse than a standard loan.
And they could obscure ownership, Buffett's concern.
Exactly. Total return swaps could separate out legal ownership from economic ownership. Vivendi apparently used them to get around EU competition rules when buying shares in another company. Also used in M&A, sometimes controversially.
Financial engineering even got rewarded by the market.
Bizarrely, yes. Cemex used put options on its own stock to boost its share price, and the market liked it, often driven by executive pay tied to the stock price.
What about reverse convertibles?
Those became really popular during the dot-com boom when stocks only went up. They paid high interest unless the underlying stock price fell below a certain level.
And when the bubble burst,
investors didn't get their cash back. They got delivered the stock, now worth far less, often at a price 50-90% above the current market price. Painful for retail.
so much complexity.
Mind-numbing. Products named after mountains or gems. Big fund managers often avoided them because they were hard to model and illiquid, but they were profitable for the banks, and often used for monetization, letting execs cash out stock gains while deferring taxes. Guess who lost out?
Tax authorities and ordinary taxpayers.
You got it.
Okay, final chapter, Chapter 9. Credit where credit is due fund with CDS and CDO. Credit as the glue.
Yeah, fundamental to banking. But credit risk was always hard to trade. It was sticky. Led to credit wars between commercial banks holding loans and investment banks wanting in.
So credit derivatives were the solution.
That was the idea. Early experiments in the 90s by Bankers Trust and JP Morgan, trying to transfer credit risk without actually selling the loans, led to things like first-to-default baskets.
Sounds diversified?
Not really. You got paid well for taking the risk on a basket of, say, 5 companies, but if just one defaulted, you lost big. It was often concentration risk, sometimes called toxic waste.
Which led to the big one, CDS, credit default swaps.
The main event. Simple concept. You pay a regular fee, like an insurance premium. If the company or country you bought protection on suffers a credit event, like defaulting on its debt, the seller pays you.
But it's not insurance.
Legally, no. Lots of careful wording to avoid insurance regulations, but functionally, very similar. The contracts themselves were complex, though. Documentary devils. What counts as a default? Which specific bonds are covered? Led to disputes.
And they helped banks with capital rules.
Big time. Holding loans requires banks to hold a certain amount of capital against potential losses, maybe 8%. But if they bought CDS protection, maybe that requirement dropped to 2%. Huge incentive for capital management. Banks then marketed credit as a new investment asset to investors hungry for yield.
And that leads to CDOs, collateralized debt obligations.
Exactly. Preceded by mortgage-backed securities, MBS. Banks bundle up loans or bonds, slice the bundle into different risk layers, tranches, equity, mezzanine, senior, and sell those slices to investors. Again, great for bank capital relief, even though they often kept the riskiest equity or first loss piece themselves.
And then it got even more complex.
Oh yes, CDOs of CDOs, known as CDO squared, even CDO cubed. That's when Nero crypt is how you get BSE, mad cow disease. Layers upon layers of leverage and complexity.
And quants tried to model this too.
They did. Started calculating things like implied correlation between the defaults of companies in a CDO pool. But death notes, nobody could yet agree on what the correlation meant or how it should be measured.
Until things went wrong.
Like in 2005 when GM and Ford got downgraded. Suddenly, correlations behaved unexpectedly, panic spread, and losses cascaded through the different CDO tranches, led to a pandemic status of CDO litigation. Banks often settled quickly to avoid washing dirty laundry in public.
So wrapping this all up, what's the lasting message from traders, guns, and money?
I think Deus would say that despite all the supposed innovation and sophistication, the fundamentals haven't really changed. Derivatives are still hot, still causing controversy. The old truths were still relevant.
Yeah, it feels like a cycle. We'll keep seeing new WMDs emerge.
Beautiful and true lies will always be the currency of trading. People will always want to see the money.
For supermodels will inevitably fall short.
Perfect storms will keep brewing.
There will always be games without frontiers and structured products.
And pain will be shared and share alike in equity markets.
Because, as he says,
in the end, there were always the traders, the guns, and the money. It's a world that demands you look past the slick surface.
Absolutely. It really makes you think, doesn't it? As the cycle continues, what are the new known unknowns or even the unknown unknowns lurking out there right now? And are we any more prepared this time around?
That's the multi-trillion-dollar question, isn't it?
Finally something to ponder. Thanks for joining us on The Deep Dive.